There is a parallel financial system being built right now, in real time, to compete directly with the US dollar. This isn't a theory. It's a multi-year project that has now reached a critical phase. For the last few years, China has been undertaking a task unprecedented in modern history to systematically re-link its currency, the yuan, directly to physical gold. In simple terms, China is building a new, alternative set of rails for how global money works. And this entire story, perhaps the most significant economic shift of this year, boils down to one single powerful word: trust. To understand why this is happening, you have to look back at 2022. That's when the United States made a fateful decision. It froze approximately $300 billion worth of Russia's foreign reserves. Now, regardless of your political feelings on that event, the financial message sent to every other nation on Earth was terrifyingly clear. If your nation's wealth is held in dollars, it's not really yours. It can be seized, it can be frozen, and it can be turned off with the click of a button. For countries around the world, especially in the emerging markets, this was an existential shock. The question they all asked was, if this can be done to a nuclear power like Russia, what happens when we have a disagreement with US policy? That event shattered the illusion of US Treasuries as a perfectly safe asset. The trust that underpinned the global financial system for decades began to crack, and so the Great Acceleration began. Central banks, quietly at first, then with increasing urgency, started to de-risk. They began lowering their exposure to US dollar assets, selling off their US Treasuries, and using the proceeds to buy the one asset that cannot be printed or unilaterally frozen: physical gold. And no one has been more aggressive than China. Look at this chart. This is the People's Bank of China's gold accumulation. For the longest time, it was flat. They'd buy some, they'd sell some. But the moment tariff threats began, the chart explodes vertically. China began publicly accumulating gold at the fastest pace in modern history, locking it up in its vaults. This is critical. This is being done publicly, not in private. China wants the world to see this. It is a direct signal to its allies and competitors. Look at our gold. We now have the ability to get off US Treasuries. We have the collateral to get off the dollar. Officially, the People's Bank of China reports holding around 2,300 tons of gold, but the real number is almost certainly far higher. Analysts at Bloomberg Economics, J.P. Morgan, and the World Gold Council estimate China's true holdings, when you include gold held by state-owned banks and sovereign funds, are closer to 3,500 to 5,000 tons. This trend is now undeniable. As Luke Groman has pointed out, gold's share of reserves on global balance sheets is on a trajectory to surpass that of US Treasuries. The dollar's share of global reserves has fallen to its lowest level in decades. The move away from paper assets is real, and it has already begun. But just buying gold isn't enough. To truly compete, China had to solve gold's biggest problem. It was just a shiny rock in a vault. The next step was to make it useful. A critical breakthrough for gold happened this year, and it went almost unnoticed by the public. As of July 2025, gold was officially reclassified as a Basel III Tier 1 asset. Now, this sounds like boring technical jargon, but it is a tectonic shift in the global financial system. For decades, under the old banking rules, gold was considered a Tier 3 asset. This meant if a bank held, say, $1 billion worth of physical gold, it could only count $500 million of that value on its official balance sheet. The system was literally designed to make gold inefficient, to penalize banks for holding it, and to ensure it remained a relic stored in a vault, rather than an active financial instrument. The Basel III rules changed everything. By upgrading gold to Tier 1, banks can now recognize 100% of its value, giving it the same risk weighting as cash or US Treasuries. This single change makes holding gold massively more attractive for every financial institution on the planet. But here is the critical distinction, and it's the key to this entire story. This change makes gold a high-quality asset for a bank's capital, but it does not make it a high-quality liquid asset, or HQLA. And that, right there, is the entire game. HQLA is the real power. These are the assets, and right now, This list is almost exclusively US Treasuries that are so safe, so stable, and so liquid that they form the plumbing of the entire global financial system. They are what banks use as collateral for repo, which is the massive overnight lending market that keeps the financial system stable. If you are a country and you want to build a port, a factory, or a power grid, you need financing. You go to a global bank and they say, "Fine, we will lend you the money, but you must first deposit HQLA US Treasuries with us as collateral." This mechanism is the link. It is why the US dollar is indispensable. To borrow, to build, to trade on a global scale, you need dollars to buy the treasuries that act as the collateral. Gold was now a Tier 1 asset, but it still wasn't on this exclusive HQLA list. You couldn't use it for repo. You couldn't use it to finance development. It was a more valuable rock, but it was still just a rock in a vault. And this is where China stepped in. If gold could be upgraded to HQLA status, it would go from being a passive store of value to an active, productive financial instrument. It would become a direct competitor to the US Treasury. It would be a new source of collateral that could be used to borrow, to lend, and to fund massive infrastructure projects, all without ever touching the US dollar. This would effectively end the dollar's monopoly on the world's financial plumbing. For years, China has been trying to convince the BRICS nations Brazil, Russia, India, South Africa, and the new members to use the yuan for trade. But they all pushed back with the same logical questions. The conversation, hypothetically, went something like this. China says, "Please use our currency." The BRICS reply, "We'd rather use the dollar, but what is your yuan backed by?" China says, "It's backed by our economy, the factory of the world. But as a perk, we'll let you convert your yuan to gold anytime you want." The other nations were intrigued but asked, "That's cool. Where is this gold stored?" China's answer was, "In China." And with that, the conversation was over. The other nation said, "No thank you. We've seen how that movie ends with the US. We are not going to trust you to hold our gold any more than we trust Washington." This problem of trust, custody, and utility seemed unsolvable. But at the most recent BRICS summit, China revealed it had a brilliant, systemic solution to every single one of these problems. China's solution to these problems is brilliant, systemic, and already in motion. First, to solve the problem of trust and custody, China built what is now being called the Gold Corridor. Think of this as an analog version of the blockchain. Instead of a digital ledger verified by miners, this is a network of physical gold vaults verified by nations. China has established new vaults and partnerships, all linked to the Shanghai Gold Exchange, or SGE, in key locations like Hong Kong, Dubai, and across other BRICS-aligned nations. Now, if India or Brazil wants to hold gold, it doesn't have to send it to Shanghai. It can store it in a decentralized, geographically distributed vault that it can access and audit. This one change fixes the problem of centralized trust. The second problem was volatility. You cannot finance a 20-year infrastructure loan using an asset whose price swings 5% in a single day. So China is solving this by creating a new settlement mechanism. Instead of using the daily spot price of gold, this new system is designed to use a moving average, for example, the average price over the last 200 trading days. This smooths out all the short-term volatility and creates a stable, predictable price, making gold a practical asset for large-scale, long-term financing. Now, here is the masterstroke. This is how China forces gold to become a high-quality liquid asset, or HQLA, without ever asking the West for permission. This new network isn't just for storage, it's for financing. Think about a country in Africa that is rich in natural resources like gold, but has no infrastructure. Under the old system, they had to go to the International Monetary Fund, or IMF, beg for a dollar-denominated loan, and agree to Western-led conditions. Under China's new system, that country can simply deposit its physical gold into a local SGE-linked vault. Then, the new development bank, the BRICS Bank, can instantly lend them yuan against that gold as collateral. That country can now build its roads, its airports, and its power plants, all financed by its own gold. and all without a single US dollar or a trip to Washington, D.C. That is how gold goes from being a passive rock to an active financial instrument. China is bypassing the IMF and creating a parallel system where gold already is the high-quality collateral, and the United States knows exactly what's happening. Do you remember earlier this year when the US suddenly began repatriating its own gold from London? The official stories were about tariffs or a Fort Knox audit, but that never made sense. The real reason, in my analysis, is that the US sees China's gold corridor. If the world is moving toward a system where physical custody and the location of gold is everything, then the US needs its gold back on its own soil, ready to compete. So, what does this mean for investors? On a practical level, let's look at the price of gold. Right now, most financial institutions, central banks, sovereign wealth funds, pension funds hold somewhere around 20% of their reserves in gold or equivalent hard assets. But new guidelines are now being published by major banks, suggesting that in this new, more volatile world, that number should be closer to 30%. That 10% difference may not sound like much, but across the entire global financial system, that represents an estimated $2 trillion of new demand. You cannot print $2 trillion worth of gold. This is a wave of demand for an asset with a very limited supply. But the biggest takeaway is this. We are witnessing the great monetary split. For the first time in modern history, we are entering a multi-monetary world where governments must compete for what money is. On one side, you have China and the BRICS building a system where money is backed by something physical, old, and tangible. Gold. On the other side, you have the United States, the world's largest exporter of paper currency. If China's system is collateralized by gold, the US will have to counter with its own greatest strength, technology. This is where the US could pair the dollar with stablecoins, tokenized assets, and perhaps Bitcoin. Think about it. Gold represents trust through time. It's physical, slow, and has thousands of years of history. Bitcoin represents trust through math. It's digital, transparent, fast, and borderless. China's system is built on control and hard collateral. The US system could be built on hard collateral and openness. These are two competing visions for what comes after the dollar system, and in a world where both can exist, the prices of both gold and Bitcoin could be repriced very, very quickly.